It's Friday, August the 19th, and we're a day late doing our videos because we had a commitment yesterday in Martinsville, but here we are. We want to just give you a heads up. The heads up is don't take the head fake bounce that we're head fake or the dead cat bounce that I think we're witnessing right now. I mean, when you go back and look, April was a bad month. May was not bad. June was a bad month. July has been a good month. August, we've had a winning streak for about 4 weeks. But I do believe we're going to see, again, that head fake and probably see a little bit on the downside coming up.
The market, we think, has gotten ahead of itself. Anticipation. It illustrates what the market can do when it begins to get good information. 2 days ago, then 5 days before that. So earlier this week, the market rallied in 5 straight days and we're up. But it was up with the anticipation, or it was up based on the information that the inflation rate dropped from 9.1% in July to 8.5%. The zero rate, President Biden called it, to 8.5% in August.
Still a 41-year high, by the way.
Thinking that, okay, that was an indication of of inflation rolling over, and then really implying or laying on top of that, that is the market's thought, well, surely the Fed won't give a 75 basis point increase in September, and they're going to start half to loosening, and maybe they'll even go back to quantitative easing and putting money in the market. And wrong.
No.
We don't believe it. The vast majority of folks don't believe it.
Well, when you got such a spread between the Fed funds rate, which is, I think, at 2.25 right now, and you've got inflation at 8.5.
Right.
Do the math on that. It's about 6% differential. That's a huge gap between where inflation is and where the Fed is trying to get to. So what the Fed would like to see happen is that the inflation rate would come down because of what they've done, and that they can meet in the middle somehow.
And that's going to take some time. Yeah. So there's your head fake. We again earlier this week purchased another round of some Treasury bills with rising interest rates. We're noticing those Treasury bills really getting into the threes and potentially has the ability to go to the 4% range.
And most of the purchases we just did were for 90.
Yes.
90
now there's
days.
the difference. We've shortened the time frame down because now what we have, as I've illustrated with clients and you have that we're meeting with, we have not only cash on the sideline, we have money coming up in 3 months, money coming up in 6 months, and money coming up in 1 year. So we have windows of opportunity that we will be looking at portfolios at that point in time with available dollars. We still have parts of your portfolio in the stock market.
Oh, absolutely.
And over those 5 days you participated, and it's done well. So it's steady as you go. Don't take the head fake.
And we're not.
We aren't. If you have any questions, you can always call us. We'd be glad to sit down with you and talk with you about it, talk with you over the phone, do Zooms. We're super busy, but we're super busy because it is your money.
And your money matters.
See you next week.